Welcome to the last video for balance day adjustments. Today we are looking at revenues, but let's just quickly recap what we've done. So firstly, we've done inventory gain and loss, inventory write down. Then in unit 4, we looked at prepaid and accrued expenses, then depreciation. Following that, non-current assets, either selling them, trading in, and the general disposal. And bad debt and allowance for doubtful debt was our last video. And today we're looking at revenues, both unearned and accrued. So before we jump into anything else, I think we need to just explain what these terms mean. So unearned revenue is when we as a business receive cash in advance for services we are yet to provide. That means revenue is yet to be earned. The most common example is buying items on lay-by or airfares. And there is a distinction as well here. So for example, if we own an office space and we rent an office out, that revenue will be different to say a lay-by, which involves inventory. We'll go through both distinctions. Then we have accrued revenue. And this is when revenue has been earned, but the cash is yet to be received. Now, if this sounds like accounts receivable, that's because it operates in a very similar premise. We'll talk about that. But again, the difference for accounts receivable versus accrued revenues is accounts receivable is based around that primary activity, whereas accrued revenues is other activities. The most common one will be interest. But we'll look at that verifiability, especially from a memo, and compare that to an invoice. So we've got those little comparisons there we'll make. So without further ado, I think now is a good time to move into our example. So our example, the first one, this is looking at unearned revenues, and it will be on October 31st, Business C received $4,000 plus GST for the next 2 months rent on an office space that they rent out to a small accountant. The reports are prepared monthly. So we're going to show the balance day transactions on both the 31st of October and the 30th of November. So we've received cash for a service a service yet to be fulfilled. That would be unearned revenue. And the example here is bank is going up by the total amount GST and the unearned rent revenue. So bank, 4,400 debit because it's asset going up. And then GST clearing, we receive the GST. So that needs to go up, and that's a liability, so it's a credit. And unearned rent revenue is 4,000. This is considered a liability unearned rent revenue because we have a future economic obligation, this time not in the form of money, this time in the form of providing a service. We'll recap it at the end. So unearned rent revenue, you can see here, credit 4,000 with the cross-reference bank. Meanwhile, GST clearing, also a credit 400 cross-reference bank. And then on the bank account, both accounts being cross-referenced for 4,400 on the debit side. So that's everything on the balance sheet. We can see here unearned rent revenue would be a current liability because it's going to be used up in the next 2 months, or we're going to fulfill that within the next 2 months. Next, we move over to November 30, and we can see here that they paid 2,000, so 4,000 divided by 2 is 2,000 per month. So unearned rent revenue will be a debit of 2,000 because when we fulfill that service, that liability goes down, and the rent revenue, which we've actually earned now, being the revenue going up, is on the credit side. And you can see the adjustments we've made on our general ledgers. Now, if we look at the general ledgers, we can see that the rent revenue, being a revenue, is going up. That's a credit of 2,000 with the cross-reference being unearned rent revenue. And if we look at the unearned rent revenue account, which is a liability, we can see a debit right there of 2,000. So the balance of that unearned rent revenue is 2,000. And again, on the balance sheet, that will display as such where it's in the current liabilities. So that's the balance day adjustments for any unearned rent revenue. Now, if we go to unearned sales with a deposit, we can see that both liabilities, the concept stays the same. We're receiving money for a service or a good we are yet to provide, still a liability. So let's have a read. On November 10, Business B received a deposit of $1,000 for a sale worth $3,000 plus GST. On the 15th of November, the customer collected their inventory and paid the balance in cash. The inventory had a cost price of $500. So a little bit going on there, but let's break it down. So there was $1,000 deposit. Then on the 15th, the customer collected their inventory. So that means the total sale worth $3,000 plus GST that was then settled. And after that, we also note the inventory had a cost price of $500. So this is very similar to a cash sale with an extra step. But we'll record the 10th of November first, which is the deposit. You can see here, bank being an asset is a debit of $1,000. Meanwhile, unearned sales, like unearned revenue, will be a credit of $1,000 because it's a liability. And that's reflected as such in the bank and unearned sales general ledgers where they cross-reference each other. Now, on the 15th, let's record that. So what we need to make sure of is firstly, we're putting items in the right order. So firstly, the first number I would look at is the sales 3,000. And that would be in the sales account on the credit side. So 3,000 there. GST, which we would receive because that's the point of transaction, would be an extra 300 on the credit. And you see both those numbers right there. Now, if we look at the unearned sales account, we can see we need to pay them first. So that's 1,000 because ultimately we want the unearned sales account to equal 0. And the remainder would be paid upon settlement. And right now you can see bank plus unearned sales is 3,300, which equals GST clearing and sales also 3,300. And then cost of goods sold and inventory, like any other sale, will be cost of goods sold, a debit 500, inventory credit 500. Now, in the event this is not a receipt and it's instead an invoice, the only thing that changes is bank would become accounts receivable. That's the only change. Otherwise, it is much the same, and that's only if the 15th was an invoice. All right, if we look at the general ledger, we can see right now the bank would be a debit 2,300 because we received that money. And we can see the unearned sales account, which had a credit to start with of $1,000, now has that debit to give it a balance of 0. Meanwhile, GST clearing is a credit of 300, likewise sales credit 3,000. These are what we're used to doing, and the inventory cost of sales amount very much all the same. So just a quick note of any alterations, FYIs. If the full amount is paid and not just the deposit, then the GST would actually be recorded upon the full receipt. So if they just pay it off and then just wait to get it later, that again is unearned sales, but it's the whole amount. If the customer will pay the balance after the inventory has been delivered, then bank again will be accounts receivable, and this is denoted by an invoice source document indicating a credit sale. And just remember to deduct the total from unearned sales. At this point, at the point of sale, the unearned sales will become 0. And that's what we evidence there. Unearned sales becoming 0. So just remember to deduct the unearned sales from the amount received in total. So the total worth of the sale. That'll make sure we get the correct bank number. And at the point of sale, after the whole settlement, the unearned sales account will become zero. So it either goes to accounts receivable if it's credit, otherwise it's bank if it's cash. And last but not least, we have accrued revenue. So this is revenue we earn but will receive later. So here is our example. On the 1st of October 2024, Business A had a term deposit of $10,000, which earned 10% interest per annum, which is paid every 6 months to the bank account of Business A. The Business A prepares its reports every 3 months, so quarterly, starting at December 31, March 31, June 30, and September 30. We need to record the balance day adjustment for December 31st and March 31st. So, for the 31st of the 12th, the first thing we need to do is how much revenue have we earned? So you would go total amount times the interest rate times n over 12, because it's not for the full year like that 10% indicates. And it becomes 3 over 12 because 3 months have passed. And that total amount is 2,250. And that total amount is 250. And if we were to look at the general journal, we can see accrued interest revenue. This time it's an asset because we have a future economic benefit, is a debit of $250. Meanwhile, interest revenue, which we have earned, is also $250. And if we have a quick look at the general ledger, we can see accrued interest revenue, which is balanced on the 31st into the 1st of Jan. Interest revenue creating the debit balance carried through to the 1st of Jan. Meanwhile, interest revenue will get closed on the P&L summary account to ensure we meet the accrued assumption. If we fast forward on the 31st of the 3rd, we need to do the payment for 6 months. This time it's 10,000 times 10% times 6 over 12, which means $500 was paid. And there's a small process. So, first thing we want to do in this 500 is we want to cancel the accrued interest first. We want to make sure that is paid. So because that was a debit balance, we would have credit accrued interest revenue, $250. The remainder will go towards the interest revenue, which interest revenue, being revenue going up, is a credit of $250. Meanwhile, the bank will be the total amount, which we calculated above. It was $500, and that is a debit of $500. And we can see that on the accounts on the screen. So we just make sure we address that appropriately. And then we have a look at the bank general ledger. We see it's a debit and it's cross-referencing both interest revenue and accrued interest revenue. Meanwhile, the interest revenue account is $250 this time to bank because it's been paid straight away. And the P&L summary will close that off. And then lastly, we look at accrued interest revenue. We see the starting balance in the debit side closed off or made zero by the balance day adjustment on the 31st, which is receipt of that loan. So if we have a look at the balance sheet, we can see the accrued revenue account is a current asset. So that's an important little bit to note. Meanwhile, as we stated previously, unearned sales revenue and unearned revenue, so unearned sales versus unearned revenue, there is a difference. Both current liabilities, similar to, say, an accounts payable. Now, these items directly are not in the income statement. It's the revenues they create which go in there. So when we're doing these, making sure we're able to calculate and place them in the appropriate accounts. So that is everything for balance day adjustments. Thank you for listening. Please like, share, and subscribe. I wish you all the best for the upcoming SACs, and I will see you next time.